Live from Asia, Europe, and the United States, this is CNBC's Worldwide Exchange.
Well, let's move on to get more reaction on this and how this impacts your investments. We are joined now by Emily Sanders. She is CEO at Sanders Financial Management, live from New York. Emily, good to have you with us. You heard what Bob just talked about, Hank Paulson's plans. What do you think of it?
Well, Christine, the regulations have to have teeth, and it really doesn't make sense that small registered investment advisory firms of $50 million under management are scrutinized by the SEC, but the large shadow banking system of hedge funds and private equity that manage trillions are just flying under the radar. So it is long overdue. And when you think about, after Enron came Sarbanes-Oxley, and after 9/11 came the Department of Homeland Security, certainly it's time to overhaul the securities regulations that really haven't had a major change since the 1930s when the SEC was formed.
Emily, Hank Paulson worked for decades on Wall Street. He's a friend of Wall Street. I mean, do you think that he's now gone so far to the other side that he's going to try to implement things that really have teeth to a lot of the institutions that he was loyal to before he went to work for the government?
Well, apparently he's not, and let's face it, with all due respect to the intelligence of Secretary Paulson, he's no Robert Rubin in terms of inspiring confidence in the market. So, it's not quite like the fox guarding the hen house, but I would say that this is going to give a lot of, at least his 200-page proposal is going to give still a certain amount of self-regulation to the financial entities. And while I'm not in favor of throwing free market forces out the window, clearly, if the U.S., which is the biggest economy in the world and has the most deep and sophisticated financial system, could practically throw the whole world into a global financial crisis, something has to be done.
Well, Emily, we're putting the ribbon on the first quarter here in the U.S. markets, and it's a pretty frayed and tattered ribbon, to be quite honest. So give us something or a sector or something you're looking at that gives you some optimism as an investor moving into the second.
Yes, well, first of all, there's less risk in the market now than there was at the beginning of the year. And I know that's strange to say, but we're already down so much that a lot of that risk has been wrung out. We think that the financial crisis is about 75% over. And when you look at the global markets, really, the U.S. hasn't fared quite as badly as Europe and some other countries that are down, even in double digits. But the ones that are in positive territory are countries like South Africa, Jordan, Egypt, Kuwait, which actually depegged from the dollar recently, places that don't have very liquid markets, but you wouldn't expect them to be up in such a down year. So I think the key is looking at the whole decoupling story and looking very closely at China. I mean, they have billions of people who are about at an economic level that England was in the 1930s, and they're just vying to get into the middle class and have cars and give up their bicycles. So that's a very powerful force that's being unleashed. And as these people move into the consumer society, we feel that the only engine at the moment that's really driving the global economy is China, India, and to an extent, the Middle East. So that's where we'd be looking in the short term, as well as, U.S. blue chips that are pretty undervalued, and the tech sector, which, is poised to rebound pretty soon here.
Yeah, hey Emily, it's Ross. It was nice when you were this side of the pond, actually. It was glad to see you got back home safely, though. Look, you talk about, and everybody talks about this China-India play, and we know that they're in those countries, though, they're also looking to slow some of the growth. They've got an inflation problem. How do you leverage that? What's the best way to invest? If you're sitting in the States right now as you investor, what's the best way to leverage that growth?
Well, you're absolutely right. I mean, inflation is 8 or 9% in China, and it's really getting out of hand. And we still have all these currency issues that will probably come to the fore at the G7 next month, when we anticipate there'll be some currency intervention. So what we would say is, put a fair amount of your equity into the global markets, and even the emerging markets now, which are more volatile, but just keep dipping your toe in the water cautiously, and look at those Chinese stocks, look at those Indian companies, and you know, of course, have a core holding in the U.S. Because it's still the deepest, most stable market on earth. And as I said, we haven't been hit quite as badly as the rest of the world. But certainly, you know, Europe will be following suit soon thereafter. We predict that the Bank of England and the ECB will have to lower rates pretty soon here, probably within the month or so, even though there is inflation in Europe. So the U.S. is, you know, having a bit of a contagion effect, but we feel that when there's such low consumer confidence, and even, you know, the CFO surveys, CFOs are very pessimistic right now. So, you know, when everybody's pessimistic, that's the time to start looking for values and buying. So we would be starting to deploy some of that cash and getting back into the market.
All right, Emily, we hear you. Thank you very much for being with us. Good talking to you. Emily Sanders, CEO,
Thank you,
Sanders
Christine.
Financial Management.